In this session, we turn our attention to technical analysis, which takes a very different approach to analyzing the share market. We're now concerned not with the real value of a share, as the fundamentalists are, but we're concerned with the perceived value of a share. For example, let's assume that at the moment a share is trading at 10 Rand. And let's also assume that there are 500 investors that are currently looking at that share as a potential prospect. And of those 500, 300 investors consider that 10 Rand is relatively inexpensive and that the share is an opportunity at that price. The other 200 consider that the share is highly priced at 10 Rand and therefore they consider it to be expensive and they will not purchase it. Now, simply because the majority of those investors consider the share to be inexpensive and they will act upon those feelings, the share price will most likely rise in response to the majority of the markets. And therefore, it's not so much what the share is really worth, it's rather what the market perceives that share to be worth, and moreover, the majority of the market that is able to move that share one way or the other. In order for us to gain an understanding of technical analysis as we understand it today, let's go back in time to the turn of the century, to the father of technical analysis, a man called Charles Dow, who gave his name to the Dow Jones Index. And let's look at how Charles Dow started patterning share price movements. His colleagues those days in Wall Street were very much fundamental analysts, and they were looking at the market from that perspective, evaluating financial statements. Charles Dow started drawing graphs of share price movements over time, and he started noticing some very interesting patterns. He noticed that over a period of time, a share price moving upward would surge up for a period and then come back a little bit, and then would renew its surge and come back, and so it would move up and down, but generally speaking, the trend was upward, it was rising. We describe that as a bull trend. In terms of Charles Dow's definition of a bull trend, it's a series of higher highs and higher lows. The highs getting higher and the lows also getting progressively higher. That is described as a primary trend, and it lasts for a period of years. Within that primary trend, there are phases when the market is coming off. These phases are reactions against that primary trend. We call them secondary reactions. And more specifically, within the context of a bull trend, those secondary reactions are referred to as being corrections. So if you read in the newspaper that the market is correcting, you will understand that within the context of a bull run, the market is at the moment dropping down, prices are softening, falling off. A correction will generally last for periods of months, and then, of course, the market, if it's still in that primary bull phase, will continue on its journey upwards. There's a third component within that trend, and that is referred to as being a minor fluctuation. And a minor fluctuation is a daily or a weekly move. And the minor fluctuation gives the graph its jagged nature. It's never smooth as it appears here. It generally moves up and down over periods of days or weeks, and that volatility gives the share price its jagged character. So within a bull trend, then, we have these three movements, these three patterns. As technical analysts, we can attempt to take advantage of the cycle upward, in other words, the secondary cycle, in which the market moves up and then its secondary reaction, it comes off, and then we can hope to take advantage of the next surge up. Or, as a more long-term investor, we might hope to simply buy the share at the bottom of the bull market and sell out as close to the top as possible. The reverse of the bull trend is referred to as a bear trend or a bear market. And a bear market is a series of lower highs and lower lows, which means that each of the subsequent highs in the market is lower than the previous one, and each of the subsequent lows in that particular market is lower than the previous one as well. So the primary trend is referred to as a bear trend, and it too lasts for a period of years. Within that bear trend, we have phases where the market is in fact going against the trend. In other words, once again, we have phases which are referred to as secondary reactions. And the secondary reaction within a bear market is referred to as a rally. So if you read in the newspaper that the market is rallying, you will understand that prices are going up at the moment, despite that the long-term trend is downward, is a bear market. And also within that market, you will expect minor fluctuations to occur.